In this lesson, we will learn about the weighted average cost of capital and how it is calculated. This is a fundamental concept in corporate finance that every investor and financial analyst needs to understand. So what exactly is the cost of capital? Simply put, it's the rate of return that a firm pays to its bondholders and equity holders. Think of it this way. When you invest in a company, you expect to earn a return, and that return should be higher than what you could earn from another investment with similar risk. This expectation is the cost of capital from the company's perspective. Companies don't just raise capital from one source. They use multiple forms of financing, including common equity, preferred equity, debt, and other instruments. Each of these sources has its own cost, which we call the component cost of capital. The overall cost of capital for the company is an average of all these individual component costs. This brings us to the weighted average cost of capital, or WACC. It's the average cost a company pays for its financing, but here's the key. It's weighted by the proportion of each capital source in the company's capital structure. WACC represents the minimum return that a company must earn on its investments to satisfy all its investors, whether they're debt holders, preferred stockholders, or common equity holders. WACC is also referred to as the marginal cost of capital, or MCC. That's because it represents the cost of raising one additional dollar of capital. When a company is considering new investments, WACC tells them what it will cost to fund that investment. This diagram shows how WACC is conceptually broken down into its equity and debt components. As you can see, the total cost of capital is a blend of what the company pays for its equity financing and what it pays for its debt financing. Here's the formula for calculating WACC. The formula combines the cost of debt, preferred equity, and common equity, each weighted by their proportion in the capital structure. Let's understand what each symbol means. The subscripts D, P, and E represent debt, preferred equity, and common equity, respectively. The letter W represents the weights or proportions of each capital source, R represents the cost of each source, and T is the company's marginal tax rate. In the WACC formula, the term RD times 1 minus T refers to the after-tax cost of debt. Why do we adjust for taxes? In many countries, interest payments on debt are tax deductible. This creates a tax shield, effectively reducing the true cost of debt. We're interested in calculating the after-tax cost of capital, so we adjust the cost of debt accordingly. Note that there's no such tax deduction benefit for preferred and common stock. Let's work through an example. Suppose a company has this capital structure: 50% equity with a cost of 20%, 20% preferred stock with a cost of 12%, and 30% debt with a before-tax cost of 8%. The company's marginal tax rate is 30%. Let's calculate the WACC. Let's set up our calculation. We substitute the values into the WACC formula. For debt, we multiply the weight of 30% by the cost of 8% and then by 1 minus the tax rate. For preferred stock and equity, we simply multiply their weights by their respective costs. When we work through the math, we get a WACC of 14.08%. This means the company must earn at least 14.08% on its investments to satisfy all its capital providers. Any project or investment that returns less than this rate would actually destroy value for the company. Let's recap what we've learned. The cost of capital is the return that firms pay to their investors. WACC averages out the component costs by their weights in the capital structure. The cost of debt is adjusted for tax benefits since interest is tax deductible. And most importantly, WACC represents the minimum return a company must earn on its investments. In the next lesson, we'll discuss some important nuances of calculating WACC that every analyst should know.